Bitcoin's present valuation and its relationship with US dollar tether USDT must be examined through the lens of global macroeconomic factors, specifically focusing on the shifting interest rate environment and the evolving risk appetite of institutional investors, which transcend simple technical and on-chain analysis. The persistent high interest rate regime maintained by major central banks globally continues to exert a subtle but significant gravitational pull on risk assets, including Bitcoin, as higher yields, unsecured government bonds present a more attractive and low-risk alternative for capital allocation. This competition from risk-free assets means that for Bitcoin to maintain its elevated price or continue its ascent, the perceived reward must sufficiently compensate for the inherent volatility and lack of yield in a non-productive asset. A potential shift or even strong signaling towards interest rate cuts in the near future would fundamentally change this equation, dramatically reducing the attractiveness of bonds and likely unleashing a flood of institutional liquidity back into high-growth and riskier assets such as the cryptocurrency market, where Bitcoin stands as the primary beneficiary. Furthermore, the increasing acceptance of Bitcoin exchange-traded funds in major global markets has fundamentally altered the structural dynamics of market participation by providing regulated and easily accessible avenues for institutional capital to deploy significant sums directly into the asset. These ETF inflows create a constant baseline demand which acts as a powerful counterbalance to any profit-taking or selling pressure from existing holders, effectively changing the supply-demand equilibrium in favor of long-term appreciation. The relationship with USDT is also intrinsically linked to this macro environment, as its stability and ability to maintain its dollar peg are crucial indicators of the cryptocurrency market's trust and operational efficiency during periods of macro uncertainty. Any systemic threat or perceived risk to the USDT peg, perhaps rising from increased regulatory scrutiny or instability in its underlying reserves, would immediately trigger a market-wide liquidity crisis, leading to massive de-risking across all crypto assets, including a severe sharp sell-off in Bitcoin as traders scramble for safety. However, its resilience and its current dominance as the primary trading pair signal that for now the market remains highly liquid and confident in the fundamental infrastructure supporting crypto trading despite the external economic headwinds. Analyzing the geopolitical landscape also reveals a hidden driver for Bitcoin's demand, as increasing global tensions and persistent inflation concerns in numerous jurisdictions continue to reinforce the narrative of Bitcoin as a non-sovereign store of value and a superior hedge against currency debasement. This flight to quality, driven by macroeconomic instability, provides a powerful long-term tailwind for the asset, independent of its short-term price movements and technical indicators. Institutional narratives are also key, with major financial institutions increasingly integrating Bitcoin into their offerings and investment strategies, which further validates its status as a mature and investable asset class, reducing the historical volatility associated with purely retail-driven speculative cycles. This macro analysis concludes that while the present high interest rate environment poses a frictional headwind, the powerful structural tailwinds created by ETF demand and Bitcoin's increasing role as a global hedge against financial instability and currency inflation provide a robust fundamental foundation that positions the asset for sustained long-term growth once the global monetary policy cycle inevitably shifts to a more accommodative stance. Bitcoin's current market structure necessitates a deep examination of its on-chain metrics, which provide invaluable insight into the behavior of long-term holders and the overall health of the network moving Beyond simple price action and traditional technical indicators, we will specifically focus on the spent output profit ratio (SOPR) and the exchange net flow to gauge whether the recent price movements are sustainable or merely a distribution phase disguised as consolidation. The SOPR metric, which reflects the ratio of the realized value of a spent output to its value at the time it was created, is currently flashing signals of cautious optimism as the adjusted SOPR, which filters out transactions under 1 hour, is comfortably above 1, indicating that on average market participants are selling their coins for a profit, which is the healthy sign of a confident and functioning market. However, a rapid increase in the SOPR reading approaching values significantly higher than the current level would serve as a potential warning sign, suggesting that too many holders are realizing profits simultaneously, which historically precedes periods of short-term price pullbacks as supply overwhelms demand temporarily. Conversely, a drop of the SOPR below 1 would signal that the average investor is selling at a loss, often observed during capitulation events or the deepest part of a market correction, which is not the current scenario. Now, shifting our focus to the exchange net flow, this metric tracks the difference between the total amount of BTC flowing into and out of all centralized exchanges, providing a clear picture of trader intent and immediate selling pressure. A consistent positive exchange net flow, where more BTC is flowing into exchanges, suggests a high probability of increased selling pressure as coins are moved from cold storage or private wallets onto trading platforms to be sold or exchanged for stablecoins like USDT. This accumulation of BTC on exchanges increases the available supply pool, making it easier for large sellers to execute orders without dramatically impacting the price. Conversely, a dominant negative exchange net flow, where more BTC is flowing out of exchanges, indicates that investors are moving their assets into long-term cold storage, which is a profoundly bullish signal as it receives immediately available liquid supply, thus decreasing potential selling pressure and signaling a strong holding conviction from a significant portion of the market. The current data shows a slightly fluctuating but generally neutral to moderately negative net flow, suggesting that while some profit-taking is occurring, the prevailing sentiment remains one of hodling and accumulation rather than aggressive distribution. This lack of significant inflow to exchanges acts as a strong underlying support for the current high price levels, preventing any dramatic downward price action despite the consolidation period observed in technical charts. The stability of Usdt, which remains robust, and its consistent use across all major exchanges are crucial factors underpinning this stability. By ensuring frictionless access to liquidity for both buyers and sellers, allowing for efficient trade execution without the added risk of stablecoin depegging, which could trigger widespread fear and a flight to quality. Therefore, the on-chain metrics collectively paint a picture of a robust underlying structure where long-term holders are maintaining their conviction and the immediate selling pressure is being effectively contained or neutralized by ongoing retail and institutional accumulation, which strongly suggests that the recent consolidation is a necessary resting period rather than a prelude to a significant collapse. This comprehensive on-chain analysis provides a higher conviction base for the next anticipated directional move, which is more likely to resolve to the upside once the supply shock dynamics fully take effect following this current period of technical indecision. The overall health of the Bitcoin network, as measured by these fundamental on-chain tools, remains exceptionally strong, offering a powerful fundamental argument supporting the next phase of the bull market.